Welcome to the Market Huddle Plus, episode 40. I'm Patrick Serezna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome to the show Jospeh Wang from the FedGuy.com. Joseph, great to have you back on the show.
Thanks for inviting me. It's great to be here.
Yeah, I can't think of a more interesting time to bring you back in, especially where we are in this monetary cycle. I wanted to pick your brain on what's going on. But before we talk about things forward, I wanted to take a look back over what happened in the last year. We had the Fed pause rate hikes, and the market rally ensued, and then rates markets started pricing in this aggressive rate cut cycle in 2024. And suddenly that all turned on the dime in the first quarter of the year. And now we're halfway through the year. And the debate is whether we even see one or two cuts. What did participants get so wrong late last year? And how do you think this plays out now for the rest of the years going into the election?
So you make a really good point. Participants really got the rate cycle really, really wrong. I mean, in early January, I think we're pricing in as many as 7 cuts this year. That's ridiculous. But to be clear, though, if we look at the track record of the short-term interest rate futures over the past decade, it's not really good. There's all that famous spider chart that participants put out every now and then that shows that the market has not been very good at guessing what the Fed will do. So I think what happened over the past several months is that we had some positive inflation data earlier in the year, and the market began to think that, maybe inflation is just going to go back down to 2% steadily. And the Fed was also looking at that same data and becoming increasingly confident that inflation is maybe going towards 2%. I think at the back of the mind of the Fed and many market participants, in their heart, they believe that inflation is transitory. And so it was just taking a little bit longer to be transitory. But after the first quarter, we did get some inflation prints that threw that narrative uh, off the rails in the sense that inflation seemed to be a bit more stickier and that smooth progress towards 2% slowed down. And at that point, Chair Powell, and at that time, I think he was having a conference in Washington with Governor Tiff Macklem of the Bank of Canada, made a point and just told the market that he wasn't happy with the progress on inflation. And so it's taking longer than expected, and the market accordingly priced that in. So since then, the market is obviously not pricing in 7 cuts anymore. Right now, it's pricing in about 2. Now, the last meeting we got was in June, and the June had a Fed dot plot, and the Fed itself was guiding towards 1 cut. So the market is being a slightly more dovish than the Fed, probably taking into account the positive inflation data we got this month. Now, my own view is I think that there's probably going to be more cuts than the 2 that the market has priced in, because Chair Powell has been very clear that in order to get rate cuts, there are 2 paths. One, of course, is greater confidence that inflation will go down to 2%, but the other is a higher than expected rise in the unemployment. And it seems like we're going to get that. So first off, looking at the Fed's expectations, based on their dot plot, they expect the unemployment rate to be about 4% at the end of this year. And we're already at 4%. So it seems really strange to think that we would not have any rise in the unemployment rate for the next 6 months. The unemployment rate usually exhibits some sort of upward momentum. People call that the Somme rule, the Dudley rule, or something like that. But over the past year, we've had the unemployment rate steadily rise. And looking at the data, it's very clear that the labor market is softening. We have fewer job openings. If you look at the qualitative PMI data, it also suggests that there's some softening in the labor market, wages are decelerating. But more importantly, and this is something we haven't seen before, is that the labor force is increasing. So over the past few years, there's been a tremendous increase in migration into the US. Now, the Congressional Budget Office estimates maybe we had a little bit more than 3 million migrants last year. Most of them are undocumented, so we don't actually know how many, but millions of people are entering the country. And when you have an increasing labor force and at the same time you have weakening demand for labor, now that's a recipe for the unemployment rate to rise faster than expected. One important thing that I'll note, though, is that this doesn't necessarily mean we are in a recession, because when you have increasing supply of labor, you can continue to have growth above trend, you're just adding more people working, more growth. But because you're also adding more people, you could have a higher than expected unemployment rate. And I think that could get us to maybe 3 cuts this year.
All right. Well, I want to just touch on that employment in a second. Obviously, the Fed has a dual mandate of both inflation and employment. But how much pain will it take in the employment market for the Fed to cut if inflation stays firm at 3%? I mean, like, what would we need to see unemployment go up to for them to feel that they have to override their inflation goals to focus on the labor market?
That's a great question. So I look at this bearing two things in mind. The first is how restrictive does the Fed think it is? And the second, how does the Fed make this trade off between full employment and price stability? Now, let's start with the second. Now, this is ultimately a political choice that depends on the values of the people sitting on the FOMC. Now, this has been really easy over the past few years because we've had multi-decade lows in unemployment and multi-decade highs in inflation. At the moment, inflation, as measured by the Fed's preferred gauge, PCE, about 2.7%, and unemployment rate at 4%. So inflation has come down a lot and unemployment rate is rising. When I look at the people on the FOMC, it seems like they're people that are going to heavily value the unemployment rate. So over the past few years, President Biden has made some appointments on the FOMC. If you look at their CVs, they usually don't have that much of a background in monetary policy or macroeconomics, but they have strong backgrounds in labor. So that suggests stronger weight on the labor mandate. Or you can look at the political affiliations of people who work at the Federal Reserve. Now, in the US, when you make a political donation, it's public. So you can look it up at the government website, or Open Secrets aggregates it for you. Basically, 90% plus of the people who make donations at the Fed donate to the Democratic Party. That suggests to me, again, a heavier emphasis on labor. So I think that when a push comes to shove, they're going to be much more sensitive to the rise in unemployment rate above 4% than, let's say, inflation at 2.7%, which, while above target, not that much. Now, the second thing to keep in mind is how restrictive does the Fed think it is? So the Fed strangely thinks that the neutral rate, long-term rate, is about 2.8% according to their most recent dot plot, and they're at 5.5% right now. So from their perspective, they think that they're being super, super restrictive. Now, if your inflation target, if you're just closer to your inflation target and unemployment rate is rising, there's no need to be as restrictive as you've been for decades. You have some space to moderate, which is what central banks across the world have been doing. So, even if you were to cut 3 times this year, the Fed would still think that it was restrictive.
Well, Joseph, the interesting, I would love to just get your opinion on what is the probability that this is not going to be a soft landing. Like, there's a substantial lag time between when rate hikes are happening and when they pause to inevitably the impacts on the economy. And there's obviously no shortage of people that are optimistic that this ends up as a soft landing, which it always can. But in your mind, is a hard landing still a possibility? And what kind of a time frame do you think there will be clarity as to whether or not we got past the kind of danger points of this, and that a soft landing is a real possibility?
So of course, a hard landing is always possible, but I don't place a lot of weight on that. Now, I think if you're a standard economist or a central banker, you would say that monetary policy works with long and variable lags. I hear that, and I think that monetary policy does something. I just don't know what it does. When you have these, when the distance in time between cause and effect is long, it's really hard to attribute the effect to the cause. So the way that I look at this is that the financial system is always changing, and what you want to do is to use judgment and look at the context. Now, looking at the US, what's different this time compared to the past is that there's tremendous amounts of fiscal spending. The way that I look at fiscal spending is you're basically printing dollars, right? So if the federal government spends more than it takes in taxes, it pays for things by printing treasury securities, which is basically just dollars that pay interest. In a sense, it's like depreciating the currency. And when you are doing this at such a large level, let's say 1.5 to 2 trillion a year, or 6% of GDP for the foreseeable future, that really takes away a lot of tail risk when it comes to a hard landing. You just keep adding cash flows into the economy. So I don't see why we would have a hard landing. And in addition to that, I think what we've learned over the past few years is that policymakers are, well, they're very scared of a hard landing. So if we were to have such a hard landing, we'd have Congress, we'd have the Fed, we'd have all sorts of policymakers leap into action to try to ease that. Now, the Fed has a lot of room to cut rates, and I'm sure Congress would not have no problem spending money. So I'm not really worried about left tail risk. I think, strangely enough, what we should worry more about is right tailed risk, where actually, because we have this reaction function, um, things go higher than you would ever expect when it comes to the markets.
So let's talk about this right tail risk and try to better understand that kind of upside. Do you have a way of sizing that up? Like what would you expecting? Do you think that would be driven by simply more inflation in the system and naturally asset prices rising in that period, or do you think this is like multiple expansion, just so much money in the system that it's just pressing equities higher and higher in this condition? And is it predominantly a call on equities, or do you foresee that also impacting the bond markets?
So it's going to impact all markets, but the bond market won't like it. So the way that I look at this is that when you are, say, tremendous amounts of deficit spending, adding cash flows into the economy, at the end of the day, these cash flows filter into the hands of few people. You can look at this as amount of income inequality or wealth inequality, but it's very clear that the way the US economy is structured is that money ultimately accrues to few people. And what do rich people do with their money? They buy assets. And so at the end of the day, when you have tremendous amounts of deficit spending, it filters into the asset market and it puts upward pressure on equities, on real estate, basically whatever wealthy people buy. Now, it's not going to be good for the bond market, I imagine, but that's not really something I worry about because there are many tools for the policymakers to make sure that the bond market behaves well. Um, for example, looking through history or looking across the world, very easy thing to do would be to have the central bank have a more active role in the bond market. You don't have to think of it as yield curve control, as in Japan or in the 1940s, but you could simply some sort of ongoing purchases. For example, in the U.S.'s case, what they're doing right now is they are thinking of moving out of an agency mortgage-backed security, moving agency mortgage-backed securities out of that market and reinvesting the proceeds into treasuries. That's in support. Or, of course, you can use your regulatory powers to try to encourage private sector buyers, like the banks. So banks are highly regulated. You could easily tweak regulations to make it encourage banks, make it make sense for them to own more treasuries. So I think the bond market is not going to be a good place to be, but I don't think it's going to be a disaster because there's just so many ways to manage this.
All right, let's dig a little deeper into this, Joseph. There's a lot of people out there that believe that we are in a period of secular inflation and that inflation could see much higher levels on a sustained basis. So like even an inflation rate that stays sticky to 3-4% for a chunk of the decade in itself would be something that I don't think market participants are prepared for. What is, in your mind, the bond market currently pricing? Do you think that the bond market is prepared for that kind of a condition? And what would that kind of spell for the bond market in your mind if that was the scenario going in the years to come?
So I agree with that scenario. So the way that I look at deficit spending, as we discussed earlier, basically you're depreciating the currency. You're printing a whole bunch of dollars naturally. that's structurally inflationary, although it depends on other things as well, the productive capacity of the economy. Maybe we have tremendous developments in robotics, and of course, the perception of the public. But looking at inflation data over the past year, it does seem like we're stabilizing somewhere around 3% on CPI. Now, when you look at the bond market, obviously it doesn't seem to be discounting this. But then I think it's important to realize that many people participate in the bond market and they all have different ways of approaching this. Some people are buying and selling bonds according to their perceptions of inflation, of the path of interest rates, and so forth. A lot of other people buy bonds because, well, maybe you're a bank and your regulations encourage you to. Maybe you're a foreign central bank and you have excess dollars you need to plow into your foreign reserves. Or maybe you're buying treasuries as part of a relative value trade. Well, it's cash futures basis or something like that. So a lot of people participate in the bond market. It's just like the equity market. It's not necessarily driven by, in the case of the bond market, perceptions of inflation. Now, I mean, I don't think you would look at the equity market and think it's driven by earnings expectations and things like that, right? A lot of people buy it sometimes simply for momentum. But if we do have inflation persistently, say 3% for the foreseeable future, I think the bonds market would eventually price that in, and it would be bonds would sell off. And I think a lot of people would interpret that to be very bad for the risk markets. But I think that would be the wrong interpretation, because if your bonds are selling off because of higher inflation, structurally higher inflation, looking across the world, that actually suggests higher equity markets as well.
All right. Well, listen, I want to go on to some other countries and see what's going around the world. But before I do, I want to hit you with one last question on the Fed. Well, what is the current market pricing in for 2025 in terms of further rate cuts? Obviously, we're debating one or two this year, but when the Fed usually starts a rate cut cycle, it usually doesn't stop until some terminal rate that they've been targeting. First of all, if the soft landing scenario is the most likely, is the rate cuts that are priced for 2025 anticipating a soft landing? And if there was a recession, how deep could that rate cut cycle go?
So looking at the short-term interest rate futures, it does seem like the pricing in, let's say, as low as, let's say, a little bit around 3.8% is where they think the market thinks that the bottom of the rate cut cycle would be. And I think that makes sense based upon what I'm seeing. Again, structurally higher inflation. You are farther away from, well, basically, inflation is unlikely to go back to negative and so forth, would be very low. So, structurally speaking, when you have a large deficit, interest rates have to be structurally higher. That makes sense to me. Although I would also note that policymakers haven't actually acknowledged that. When you look at their dot plot, they're still 100 basis points below where the market is. So the market is already very clear that we are in a higher structural inflationary environment, but the policymakers have not. And what the market prices in makes sense to me.
But what if there was a hard landing, which let's just say an outlier? Let's say well, you already know that your view is more on the soft landing side. But if there was a recession, how deep could that rate cut cycle go in that circumstance? You think they could see 2% rates or something low like that?
Man, that's really depends on the just how bad is the negative shock. We'll definitely get negative shocks. I don't really think you could. So I think it's hard to look at that for market pricing. Negative shocks, by their nature, low probability events. I mean, heading into 2020, we had a tremendous negative shock, COVID. I don't think there's any way you could expect the market to price that in. If we have a tremendous negative shock, maybe nuclear war or something like that, yeah, we could go to a world where not just interest rates go to zero. Maybe we roll out yield curve control, do something like we did in 1940s, and just have the Fed finance the government as we go into world war. It's not impossible, but I don't really. It's hard to make decisions based on these very, very small probability events.
Okay, so let's move on and talk Canada. Yeah, you're right now in Canada, while I'm not, but so you're enjoying the country there. But so in Canada, they've already cut rates, and so Macklem started the rate cut cycle. We'll talk about Europe as well, doing the same. But their economy is in a much different stage, right? Their mortgage market is more sensitive to rates, and their economy right now is relatively weaker compared to that of the United States. Now, what do you make of the Canadian monetary policy and where it's going compared to the U.S.? And two, what is the impact of that differential?
So, like you mentioned, Governor Macklem recently cut rates a little bit. Now, he phrases it not as easing policy, but as being less restrictive. And as you also suggest, it does seem like monetary policy is more effective in Canada, in part because a lot of the households have mortgage rates that have to be renewed every few years. I think the Fed has recently done some work that suggests that monetary policy just transmits more effectively in Canada because of this angle. So, that's one thing. But on the other side, if you look at Canada overall, there seems to continue to be growth, and that seems to be in part due to the tremendous amounts of migration into the economy. When you look at it on a per capita basis, though, as many publications have noted, it does seem like on a per capita basis, Canada has been in recession. And so it does make sense, I think, for them to be cutting rates a little bit just to be less restrictive. And inflation is just slightly above the deflation target range that the Bank of Canada has set. So this all makes sense to me. Now, you'd think that as the interest rate differential widens, that the Canadian dollar would weaken against the US dollar. And you do see some of that as well.
Well, so like just staying on that theme of the currency, if for instance the cracks become more evident, because there's the circumstance that Canada is much more likely to actually have a negative recession print than the United States is, and therefore their monetary policy might have to ease that much more. Do you think we could have a situation where the differentials become significant enough where you see like real big currency moves happening between the two?
My own view, as we've discussed, is that the Fed is also going to be cutting more than expected. So that's why I'm a little bit hesitant as to think that there'd be a significant depreciation of CAD against the dollar. Now, just looking at the technicals, it seems like it's been kind of within a range, with let's say 1.39 being kind of a soft ceiling over the past several months. So it seems like at least there's somebody defending that. Uh, if we do really have some kind of catastrophe, you could have the interest rate differential widen and have the Canadian dollar further sell off. But just based on my views, I think I don't position for that.
Okay. Well, let's talk Europe then, because the European elections seem to have woken up the markets in Europe, and certainly, particularly in France, with shift in politics in the country. Now, there was clear moves in the euro, in the euro stock markets, and certainly, a lot of people asking big questions of what's happening. They've already started cutting rates in Europe. How do you size up the situation in Europe compared to that of the United States and Canada?
So I think Europe is in an interesting place because they did recently cut rates. Again, Lagarde frames it as reducing restrictiveness, but it's also a hard place to do monetary policy because you have all these different countries with all have different financial systems, different fiscal policies, and so forth, and are at different stages. So, for example, just following through the floating rate mortgage discussion we have in Canada, in Europe, some places also have short dated mortgages that have to renew every now and then, and others have longer dated mortgages, more like the US. And so monetary policy is going to affect them differently. So I think it's a hard place to conduct monetary policy. Now, what is interesting, and I don't think the market is fully appreciating, is that there are some big political changes in Europe. One of the things that I think will be a theme going forward is that politics is going to be a bigger driving force for markets than the central banks. And we've already seen that happen, say, in Mexico recently. We had Mexican elections, and the markets really didn't like what they saw. sold off the Mexican peso, sold off Mexican equity markets in a big way. In Europe, we recently had French elections, and looking at the most recent polling, it seems like the voters are really unhappy with how things are currently run and are either voting for, just voting for change, either it be right-leaning change or left-leaning change. So there could be really big changes in just how the fundamental rules of the system are shaped, and I don't think that risk is in the markets. So I mean, you can
No.
see this in Mexico, but looking at this and bringing it home to the US, we also have elections in November, and you have two political parties that are presenting very different visions of the future that have huge implications on markets. So, now, for example, if you're looking at President Trump, he's also very open in telling you that he would like to have more control over monetary policy, lower interest rates, weaker dollar, and so forth. That's tremendously inflationary. That's a recipe for S&P to be at 6,000 by the end of the year. Or if you look at President Biden, he's not as uh, not as interventionist when it comes to monetary policy, but looking at his record the past few years, he likes to increase. He likes migration. He likes to increase the workforce. That has tremendous implications on wages, on shelter inflation, and on growth. You're adding people right now, but in some places you're having tremendous rental inflation, say in New York City, and it's also kind of pushing the unemployment rate higher. So these are big things that are outside of the realm of the central banks that are being done by policymakers. Now, going back to France, you have a similar vision, but at the end of the day, it means more fiscal spending, which is inflationary. And beyond that, though, you could have very divergent views of how the world will work. So that's a lot of risk, I think, that's not placed into the markets. We saw a little bit of, let's say, French CDS rising, French bank CDS rising a little bit, but and the euro selling off just a little bit. But I don't think that the potential for just big changes, political changes in Europe and in the US is fully appreciated in the market.
All right, Joseph, we're running low on time, but I really wanted to wrap things up with you just sizing up what's happening in Japan. And what do you think is the next steps? Are they going to be shifting their monetary policy as everyone's anticipating? And what will the impact on the yen be?
So more recently, the Bank of Japan is making some noises, what thinking about reducing the amount of bonds that they're buying. I think their balance sheet is so large that if you reduce the amount of bonds you buy, you end up shrinking your balance sheet as the bonds you purchased in the past roll off. And so basically, they're thinking about conducting quantitative tightening, and maybe there's some murmurs that will be an additional rate hike. Now, this makes sense from looking at data. Inflation is definitely above 2%, and it seems like the Bank of Japan Governor Ueda over there is more confident about the path of inflation. So when you're looking at the yen, so a couple of things come to mind. One is that, yes, Japan is probably going to be tightening monetary policy, even as the US and other countries are thinking about making it less restrictive. But on the other hand, the absolute short-term interest rate gap between the two remains very, very wide. So I'm not sure what to make of it. It looks like, though, that the authorities don't really want the yen to go above 160. So I'm long the yen right now. I'm thinking that this, given the positioning and given the risks in the world, you're probably still ultimately going to have some kind of risk off episode that's going to cause the yen to rally. And if not, I think the authorities have shown that they don't like the yen above 160.
Well, Joseph, thank you so much for joining us. It was great to have you back on the show, and I look forward to you coming on in the future, bud.
Thanks so much for inviting me.
All right. Well, thanks for tuning into the Market Huddle Plus. We will be back next week with another episode. Cheers, everyone.